Not many defenders out there. Everyone's like, oh, President Trump shouldn't say that. You're one of the few in my email inbox who sent out a note saying, maybe the president has a point.
Well, I don't think the president should be commenting on monetary policy one way or the other. I mean, I don't think that there's that much upside for any
Hi, the rest of us do.
Well, I mean, it keeps the news cycle going, I mean, which is nice. But, you know, I think, to me, what's important is the Fed data dependent, right? I mean, why are they raising rates? Just to placate, I don't know, Goldman's forecast for 5 hikes next year? I mean, what's the point? You know, to me, is inflation moving up? And, you know, right now, to me, the evidence of that is, like, pretty thin, because look at what happened today, for example. You had the dollar breaking out. Your own Bloomberg dollar index is at
highest in a year.
Basically highs today. And at the same time, inflation break-evens are coming in. So, you know, the dollar strengthening introduces downside risk, in my opinion, to their inflation forecast for next year. So, you know, the Fed is data and forecast dependent. And if that's the case, they should be either marking down their inflation numbers for next year and or lowering their NAIRU estimates for next year or moving up their potential growth estimates for next year.
Well, Powell has laid out a case for why at least he thinks that those downside risks aren't there. And when you consider the pace of the hikes, that they have been sort of spaced out, you know, we're basically going quarter by quarter, is there not some sense that the economy is strong enough and the market is healthy enough to withstand this?
I mean, I think yes, I think that that's probably fine through the end of the year. The question is, they've gone to all this trouble to wean the markets off of forward guidance. I mean, I think that's part of why they're moving to a press conference at every meeting. That's part of the reason why they've removed that language around accommodation. They've weaned the markets off forward guidance, which implicitly means that data is going to have to drive the boat. So let's focus on the data. Financial conditions are getting tighter. And if you look just at core CPI inflation over the last 3 months, it is not consistent with the Fed's target. It's not consistent with acceleration. So, you know, the momentum in core inflation is weak. And if you think about looking forward, I mean, we know that rental inflation appears to be slowing in many markets around the country. So that's disinflationary. The dollar strengthening. So that suggests that this continued weakness in core goods inflation that we've seen at the consumer level is likely to continue. So, you know, I don't think inflation is going to, you know, go back to like 1% or something like that on a year-over-year basis. But you know, but is it going to accelerate? I'm skeptical of that. And remember, that's what the Fed has in its forecast.
Interesting that Richard Clarida was speaking today, the vice chair, and he seemed to be basically putting to bed the fact that they're going to be looking at stock market falls, as we saw yesterday, as anything they're going to go by. He was saying, look, further gradual adjustment in policy rate range will likely be appropriate. We were speaking to guests yesterday who said, look, the market has to fall by 30% until the Fed takes notice. Where do you assess that it might look at the market?
Well, I don't know that it would be 30%. I mean, that to me is... The question is why. Yeah, I mean, the question is why. I mean, if the market's selling off because rates are backing up, that's one thing. But if the market's selling off and rates are falling at the same time, that's something. So it's, I mean, you have to think about it more holistically, I would say. It's not just sort of a, you know, 30%, 15%. You know, so I don't really think about it that way. But Clarida's speech, I mean, today, I mean, there were some interesting nuggets in there. I mean, he sort of gave a nod to lower NAIRU, gave a nod to productivity, gave a nod to the idea that, I mean, I think he was kind of pushing back a little bit on what Brainerd said back in September.
Caterpillar shares are down 27.5% since October 3rd. October 3rd is the day that Chairman Jay Powell said that there was still a long way to go to get to neutral. How much is, in your view, the market turmoil that we've seen basically throughout October a function of people coming to the concerns that you're talking about, that there is some sort of disconnect between where the Fed sees itself going and what the data is saying?
I mean, I don't have a good answer for that, because if it's like a rates-driven sell-off, why are the utility stocks outperforming so much? I mean, you'd expect the opposite scenario. I mean, you'd expect the front end to be rallying and then yields to be going up. And in fact, that's not what we've seen. So rates have kind of hung in there. I mean, the short end of the curve hasn't really moved all that much. I mean, it's coming a little bit, but... So, you know, I don't know. I mean, you could talk about, people talk about trade, people talk about tighter Fed. You know, to me, the market, I mean, overall financial conditions, in my view, are still okay. They're not a drag on growth by any stretch. Corporate credit is still pretty healthy. But as I say, I mean, just look at what's happened recently and just think about if this continues. I mean, to me, it's really about the dollar. The dollar's like the escape valve. And when you look at what's going on globally, we have, you know, European PMIs at 3.5-year lows. At the same time, the U.S. PMI is strengthening. And look at what the Fed said in its minutes, right? They talked about trade tensions, they talked about global growth divergence, and on the upside, the potential for stronger, basically growth in the U.S. based on confidence and fiscal stimulus.
Yeah.
All three of those risk factors lead you to one place. Dollar goes up. And so if dollar's going up, I mean, that almost has a mechanical impact on consumer prices.